Got it. All right, I'm waiting for this thing to stream to YouTube and then we'll start up. It sucks we couldn't get this done or do the meeting last week because I was super pumped at what happened with inflation and those readings. Pretty cool to see. We pretty much hit it right on the head. The market was predicting 8% flat. I was thinking 7.8, and it came in at 7.7. And that basically drove rates down a whole 0.5% in a day. I think we had what was that day? I'm trying to check now. I think it was like 200 basis points. What was this move up? 199. It was about 150 basis points move in the right direction for mortgage-backed securities. And so basically what happened is that inflation went up month over month, right? It increased 0.4% from September to October. But remember, we got to consider last year's, which was at 0.9. And that's the reason why we went from 8.2% inflation to 7.7, because that 0.9 minus that 0.4 gives us an extra 0.5 that we're minusing out. And so now that put us into that 7.7 territory. And it kind of shows that inflation is coming down year over year, which is kind of counterintuitive, right? That month over month is increasing. But you have to consider that last year, those month over months increased as well. And those month over month increases, they are going to stop, I think, in February, March, because the biggest is housing. And housing is like a lagging indicator when it comes to consumer price index and inflation in general. And in February is when those housing numbers were starting to increase, very similar to that CPI that we were saying, where it was at 0.2, 0.2, 0.2, and then 0.9, then 0.7. That same thing's going to happen with housing on that month over month reading. And by February, we'll see that inflation's really going to start coming down, where to the point where that month over month may not even be at 0.4, maybe 0.1, and maybe 0.0. And that's going to cut down inflation year over year. Producer price index, which is inflation on the wholesale level, that also dipped from 8.4% to 8% year over year, right? And we talk about this a lot because we know that this is the leading indicator for rates. So our high in rates was a couple months ago. I think what was it? I think it was September, where we hit like 8%, right? And people were paying points on that 8%. Today, we're at anywhere between 6.5 to 6.75 on those conventional loans. And there may be some points on there, 1.5, but we're starting to see rates kind of get closer to that mark that we had of 5% leading into mid to late next year. So it looks like we could actually be ahead of schedule if inflation continues to come down. And that would be very, very nice, because we are getting clients basically saying that they're still waiting for home prices to come down and things like that. So now's the time to kind of say, hey, we can't really time the bottom. We think that it was at 8%. We think that the highest rate was that 8% that we saw a couple months ago for a week or two. We don't know that. If you can afford to do it now, let's jump into it, because if you're waiting for rates to come down, you're waiting just like everybody else. It's going to be jumping in at that time, as opposed to just buying the house and then refinancing in a year or so and getting that interest rate. But now we're kind of really seeing it with with the data that we've been talking about since June or May, when we were saying October, November, that was really the month, because that October year over year. Next month's going to be the same thing. It's 0.7%, right? So if we consider that same month over month at 0.4, right? 0.7 minus 0.4 gives us that 0.3 extra, which would minus that down from that 7.7, which will put us at about 7.4. So you're going to continue to see inflation come down. In terms of, from what I'm reading with the Fed specifically, they may be done by not December, by February is going to be their next meeting. So they have a December meeting and then a February meeting. That may be their last rate hike. And then they're going to just kind of let the market play out. But with people kind of already seeing an end to it, and they're really seeing that nothing has changed, because inflation has come down, but we haven't seen increased job losses and things like that. We're gonna see the stock market continue to rally for the next couple of weeks or so. In terms of that, not my specialty. I focus on mortgages. I can't tell you if the stock market's going to go up or down. But I do think that with that Fed pivot, it's good news for the market in totality. Existing home sales fell 5.9% from September to October. This was actually stronger than expectations of a 7% decline. So even though home sales are still dropping down, they're actually down 28.4% year over year. We're still coming in stronger than expectations. I think this is because the same thing, right? Supply and demand, unfortunately, you're still going to have people that need to buy a house. Millennials are like the second biggest generation. And right now is the time for them to start purchasing. In terms of new construction, housing starts fell 4.2% from September to October. National Housing Market Index, which is that number from the National Association of Home Builders that measures whether they build or contract. Remember, that's like from 0 to 100. It hit a new low of 33. Anything above, or 50 is the flat line, right? So anything above 50 means that they're going to continue to build. Anything below 50 means that they are going to contract. So they're at 33, they're at a new low. So we're not going to see new home builds or plans of new home builds anytime soon until that number kind of gets back to that 50, 51, which I believe will happen as rates come down. Actually had sent over an email this morning to a client that told us the same thing, that they're going to wait for home prices to come down in South Florida. I think I showed you guys that Case-Shiller before. I'm going to pull it up now just so that you guys have that reference. Or is it? This is it. Perfect. Let's get out of here. Share screen. Okay, now when you're talking about nationally, home prices coming down, yeah, I would say you can continue to wait a little bit, even though realistically that 13% year over year, if rates do come down, let's say in the first quarter of next year, which realistically I think is going to be towards the end of the first quarter, beginning of second, if it is that soon, that year over year number is going to just start increasing again. But when you're looking at this nationally, remember, regular home price appreciation is 3 to 5% per year, right? But that's usually on the national level. So for Miami to be more than double of what this is, by the time this hits 3 to 5%, this will probably still be in the 20s, very low 20s or very high teens, 18%, 19% year over year. So if you're talking about a dip year over year, it's not going to be that great. And I don't think it's really going to affect too much, considering if rates do come down in the next 3-4 months, which, like I keep mentioning to you guys, we're kind of seeing that right now. To be at 8% in September, all the way to 6.5 and to 6.75 in November, you're seeing that bond market move up and down tremendously and very, very quickly in months. And once we get some sort of stabilization, which I believe that stabilization is going to come from the Fed stopping their Fed funds rate and just letting the market play, letting inflation come down and stuff like that. Once we start to see that stabilization, you're not going to see that huge fluctuation like that. That's just abnormal. But with the volatility, you're seeing up and down, up and down. I'm actually going to show you guys too as well. Actually, oh, look at that. We're -5. So we actually were above 20 basis points. No, you see now we're up to 3. But what I want to show you guys is, remember, anything below 100, there's no premium, right? So 100 when you're looking at mortgage-backed securities, and let's show more coupons here, like that 6% coupon, that 101.52. So basically 100 is par. It's the same thing when we're looking at our rate sheets, right? 100 is that par rate. Anything above that would be premium. Anything below that would mean that the client has to come in with points. Basically, that's what that is. That difference in points is. So for us to be seeing premium, we hadn't seen premium since before 2 weeks ago when that inflation report came out. There was no premium, not even on the 6% coupon. So for us to be seeing the premium is a good thing. That means that Wall Street's actually paying for these rates right now. So they're basically saying at that 6%, if you give us a 6% interest rate, we're going to give you 1.52% back in return. It's not too much on average on a lender. That premium should be closer to about 2%, 2.5% return, because that 6% is not going to be an actual 6%. There's fees that kind of go into that. There's people that need to get paid in between that, all that stuff. You got, Fannie Mae needs to get paid. Servicing, all that gets put into that rate. So where if you, let's say you had a perfect scenario of that 6% being at a 102% premium, that means that the rates would probably be at about 7% without points, or six and three quarters without points, 7% without points. Right now, we're at about 6.75, 6.75 with maybe about, say, a point and a half. So still a little bit of premium that needs to be done there. The reason is because there's a big disparity. People think that rates are coming down next year, right? And you're seeing it with the bond market. They believe that rates are going to come down next year. So if they're buying, right, the way that mortgages work and the way that the liquidity in the market works is if I do a $300,000 loan, and then I'm going to sell you that $300,000 loan for, let's say, $310,000, right? The way that you make your money is more long-term as a servicer, right? You're collecting monthly payments. And over time, you're going to make much more than the $10,000 that you invested into that, right? But that's usually on a time frame of anywhere between 6, 7, 8 years is really what servicing looks like. What happens if people think, hey, rates are going to come down next year. Do I really want to take on this 7%, pay a premium for it, right? Pay that $310, and then it's off the books, and I'm losing, let's say, $5,000 off of that investment that I made. This is what has been happening this whole year, is that there has been so much uncertainty, so much volatility, that you have to come in with premium, you have to come in with points, because they strongly believe that these rates are going to come down next year. Okay. And when you're seeing this with the bond market, it means that they are in agreement with what we're saying. So it's easier for you to translate that over to your clients and say, hey, everybody does believe that rates are coming down next year, that they're going to be in the fives. You can look at click this, right? This article that I posted directly from the Mortgage Bankers Association kind of shows that they believe that rates are going to be in the fives next year. You can see it with premium and mortgage-backed securities. You can see it with exactly how we responded 2 weeks ago when inflation came in lower than expected, and that big spike that we had in the bond market. This is at 150 basis points. This is the day that we got the news for Consumer Price Index. Huge jump. Friday was Veterans Day. Then this is Monday, Tuesday. Wednesday was Producer Price Index. We got another extra bump up there. And then we've just been pretty much seeing green since the low of October 13th. So look at that. It wasn't even that long ago, but is this the 6 or the 5.5? Let me see the 5.5. Okay, it is the 5.5. So this was the lowest that we've seen rates. Let me kind of push this back a little bit. Yeah, this was that 8%. It wasn't even that long ago. It's a month ago. I thought it was in September, but it was mid-October when we saw rates at the 8s. Kind of went back and forth, and now we're up again, and we're seeing premium in these coupons, which is very nice, because less points for people is much better. Also, with those people that are still looking, right, are you guys trying to negotiate price breaks, or are you just coming in and trying to negotiate closing costs? Because price breaks are not going to do too much. I was actually last week? Yeah, one of the loan officers, he's on my team. He was basically, there was a listing for 325, and he's like, but I think we can do it. We can get it in at 300. And I'm like, well, why would you do that? You know, why would you come down 20, even if the seller accepts it, you know, why would you do that instead of just getting that money for closing costs, right? Let's say instead of 325, or it's the list price at 325, you know that the seller wants to net 300, you do 315 and you ask for $15,000 back. You can do a permanent rate buy down, or you can do a temporary rate buy down, and that's going to save the client even more money than just going from 325 to 300 and getting no credits. So it's very important that even though the client may want to get a lower purchase price, that we kind of make sure that we can help them benefit on their payment much more than anything, because that's usually the bottom line. Let me see if I have, I believe I have a tool here. Have you been seeing sellers give credits for closing lately? I have on almost every deal, actually. On almost every single deal, we're seeing credits, whether that be 5,000, 7,000, 10,000. We're always getting those seller credits in. So I'm going to share my screen again. We're actually going to do this together. I've used this once, but this is a great tool as well that we're going to start implementing too, that I found out about it last week. again, or that they reminded me about it last week. So basically, let's say that purchase price is 400,000, right? We're gonna put this. We know we're in South Florida, so we'll put that monthly home insurance. We'll leave that property tax there. No association. Let's click next. So let's say we're doing a FHA 14,000. Boom. All right. Rates at 6 3/4. Paying 1.5. Closing costs. Say 10,000 flat. Okay. Next. So we're gonna do a price break. Right. So let's say 400,000. Let's say you're trying to get it at 380. That's perfect. Down payment would still be 13,300. Seller pay closing costs. We'll do 0 because they're not going to give you anything. And we'll do a permanent buy down. And that would be at, let's say, 2.5 points. Let's do that. It's at 96.50. And so if we're considering a $20,000 decrease, right? 400 from 380, that's 20,000. That means that the cost of points here for the permanent buy down is 96.50. That overage is going to be $10,350. Let's say, okay, 10,000 flat. That's fine. Now we'll do a temporary buy down. We'll do a 2-1 here. It's going to cost the seller $9,000 for that. So let's do $11,000 towards seller pay closing costs. This is based off of that same 20,000. So that price break, right? That total monthly expenses is still going to be 3265 as opposed to that 3383, right? When you're doing that permanent buy down, you're going to be right around the same thing in terms of what that interest rate buy down is going to give you. So I'm assuming that it's going to be what the rate from 6.75 to 6.13. I think this is going to be closer to about, if you're paying 2.5 points, this is going to be much deeper than that. I believe probably like at least a full point. So I would say about 5.75%. Let's actually go back up here because I kind of breezed through it. I think it's going to be at, let's do 5 and results. Yeah. So you'll be at 3163 if you're doing the permanent, but then that temporary buy down, right? For that first year, you're doing $2,014. That's your first year's payment for your monthly principal and interest. And then you're going to actually be at, in total, $28.93 consistently. And so when you're looking at this, or when we're looking at this with the borrower, the temporary buy down for them, remember, we're assuming rates are going to come down in at least a year, right? Let's call it, and I usually push that out to 2 years. We never know what's going to happen. Let's say 2 years. The temporary buy down is going to be the best option for them for 3.5 years almost, right? So they have about 3.5 years before they have to refinance. So that permanent buy down, even though it may be good because they're thinking 30-year mortgage. So do I save on 2 years or do I save on 30? That temporary buy down, if we're assuming that you're going to refinance in that 2.5 year time frame, that temporary buy down is going to be the best option for them. So what we usually speak about with them. I haven't brought this up specifically to them. I'm showing you guys actually first. You guys are kind of like my test dummies per se, but this is going to be starting getting implemented into our consultations once I teach the team how to kind of go through it and stuff like that. It's very important for them to be able to visualize. I'm like that. That's why I do my consultations the way that I do it. I'm pretty sure most of you guys here are much more visual. So kind of break this down to them, right? 2.5 years is that temporary buy down, but let's say we're pushing this out to 10 years. All right, you're going to have that loan. Of course, that permanent buy down long term is going to be the best option for you. And then this one is the cost benefit. So the cost benefit actually in this scenario is that price break in terms of what it's going to cost them. So the actual permanent, which is, or the temp buy down, is right along that line. It's not too much more in terms of what that cost difference is going to be. $65,000. They save 65. They save 69 on the temp. Am I able to see this a little bit easier? This is on year 8, year 9. Oh, still year 4. Perfect. Yeah. So on the price break is where they're going to be saving the most money. It's not too much different from from the permanent or the temp buy down. So it really just depends on what they feel like is going to be the best option for them. I still believe that low monthly payment is going to help them in general. That price break, the reason why it's giving them the best cost benefit is right here, is because it's automatically put into that principal, and that, even though I think this may be incorrect, that mortgage insurance, that's not going to change too much. unless it's considering this, oh, year 4. Okay, that makes sense. So yeah, they're basically going to be saving off of that money right away, as opposed to that temporary buy down, which is still upfront for them, right? Because that money is put into escrow for them. And that's another thing too. Actually, that's a great point. So the temporary buy down, the way that it works, remember guys, is that it just gets put into that escrow account for them. So if they do refinance in, let's say, a year, that extra money that they have left over on that buy down for the second year, let's say that's an extra $3,000-$4,000. That's money that they get back. That's their money, because they never used it and it was in the escrow account. So that extra, let's say $4,000 plus whatever they have in actual escrow for insurance and taxes, that's money that they're going to be able to put in the closing costs for the new loan. That's going to help them kind of make sure that they have enough equity to be able to do so, because that money is theirs. It's escrow money. So this is kind of the breakdown. This is what I'm going to kind of be showing to clients that do want to pay a lower price point or get that price break that doesn't really necessarily make sense for them. Kia, you have a question?
Hey, Mike. Yeah, you were saying that this would be the best option for our clients. And my question is, what does the conversation look like with like the listing agent or the seller in terms of negotiating this for our clients?
So right now, listing agents are just accepting those credits. We see it right up front, and then sometimes we'll see it in inspections. It's just about that conversation that you're having with them up front, how you're putting it on the contract and things like that. If you're coming in at full ask, those people, especially if they have price decreases already, and you're asking for $10,000, let's say, they're most likely going to give it to you, because you're going to be one of the few offers that they are receiving. Right? There's not a lot of people buying right now. And that's why it's very important for the buyers that are on the market to make sure that we get them the best deal possible for it to make sense for them, because they're the ones that are essentially saying, yeah, I'm still out here, and they're the few that are doing that. We have a bunch of pre-approvals that we have to convince daily to continue to start to keep looking, because there's deals out there that they're going to be able to get.
Got it. Now, does this also work for new construction or no?
Yes. So we're actually seeing new construction builders do this. I actually got a quote for one last week. You have to be very not careful, but just letting your clients know that it is part of their the closing cost credit that they're going to get. So I saw that the builder was giving a 6%, which is the maximum you can give on FHA, but they weren't accounting for the extra $10,000 that you need to escrow that money. So realistically, you're only getting on that closing credit about $6,000. It's not a big deal, because you're still getting a huge discount from them. But the way that it's put on the loan estimate, remember, if the client sees cash to close at $15,000, they're going to expect $15,000, right? So it's just about making sure that loan officer labels that correctly, because that full seller credit or that full builder credit is going to go towards the 2-1 buy down, plus whatever's left over will go towards their closing cost credit. But if they're not showing that 2-1 is going to get escrowed, you're confusing the client, and they don't know that their closing costs at the end are going to go up $8,000. It's not that their closing costs are going up; it's just that you didn't do the breakdown correctly. And I saw that last week on a closing cost worksheet, which is why I warn you guys to just make sure that you're on the lookout for that. But yeah, they're doing that. They're doing that, and you can do the 3-2-1 buy down is probably the best to go with on a builder. So when you have those conversations, because they're only really willing to do it on the in-house, that's fine. When they're talking about the buy downs with the clients, ask them if they have the 3-2-1, and then tell the client, hey, you could do the 3-2-1 or you could do the 2-1. The 2-1 is going to give you the 2% lower for the first year. The 1% is going to be for the second year, and then it's going to be normal, which should be enough time. Those 2 years should be enough time in order for you to be able to refinance out of it and stuff like that. But if you feel like you need a little bit more time or a little bit steeper of a discount, you could do the 3-2-1, which is going to give you a 3% lower interest rate for the first year, 2% for the second, 1% for the third. That's going to give a much bigger discount for the first 3 years for them, but it's going to take away from the maximum closing cost credit that they're going to get, because you have to put that into that you have to put that towards the actual closing costs as well.
Got it. And then one more question.
Yeah.
You said that we need to be particular about what we're putting on the contract. Do we need to disclose the 3-2-1 or the 2-1 buy down on our contract?
So the seller does have to be okay with that closing cost. Well, not okay with it. The seller, the credit does have to say this is going towards the 2-1 buy down specifically on there. But if the seller is willing to give 8,000, they don't care where it's going. They don't care if it's towards closing costs, towards rate buy down, towards 2-1. They usually don't care. It's about negotiating that cost, and then from there you can figure out the wording.
Got it. Okay. Just wanted to make sure. Thank you.
No problem. Do you guys have? I know Tanya, you had a question earlier. No? Does anybody else have a question on this stuff? Or on anything pretty much?
Okay, Mike, I come with with all the questions. So my other question is, you mentioned the end of February or the end of first quarter, early second quarter for rates to be closer to or looking closer to being in the fives, right?
Mm-hmm.
So if that's the case, now our I guess maybe what you said earlier is true, to just wait or not wait, get it, and then refi. But do we think that they're going to be lower than those fives in the next year after that?
I don't believe so. I don't think that we're going to see threes again. The reason why we were in the threes was not only because of where the economy was as a whole. Okay, there's when you're looking at the Fed played a really big part in why rates were so low last year. Remember, they're based off of mortgage bonds, and what the Fed was doing every single month was they were buying a shit ton of mortgage bonds, and so they were basically oversaturating the price of mortgage bonds because they were basically the number one buyers of it, and they have unlimited money, so they were keeping those mortgage bonds very, very, I guess, price high, and so that's how those coupons were very, very low. It's called quantitative easing. Now with what they're doing is they're doing quantitative tightening. So all these mortgage bonds that they had, they're letting them run off their balance sheets. And so that's why we saw that's why we saw rates go up so quickly. Is because what they were doing was they were just holding down the market. And as soon as they let go, the market went to where it was supposed to. Now we're going to kind of start to see that level off because there's more mortgages being done than mortgage-backed securities being put on the market. And when that happens, that means that essentially those mortgage-backed securities are not going to increase as quickly as they probably would if it was the opposite. So I think that's why we're going to be in the fives by next year. I think we're going to be comfortably there. If we dip into the fours, that'll be great. I just don't think we're going to see twos or threes again because that came with a big help from the Fed when they were buying a lot of mortgage-backed securities last year and the year before that.
Got it. So basically, if our buyers are buying now, then we can advise them that in a year their rates will be better. But probably come second quarter, the conversation will be more so like these are the best rates we have right now, and it's probably going to be this way for a minute.
Yeah, I mean, and we'll have those conversations us here on Mondays just to kind of see where the market is going at that time, because there could be some other news that's much more beneficial for us that could lead us to continue to have those mortgage-backed securities keep coming down again. Just from past experience, I just don't think so because that would have to come from help from the Fed. And right now, they basically said that they're not giving it to us. If they were, that probably wouldn't be till 2024, 2025, if there is some sort of quantitative easing of some sort.
Another great conversation. Thank you.
No problem. Any other questions at all? No. Not today. This week is a short week, so there's not going to be too much news that comes out this week. So we may not have Monday Mortgage Minute next week. I'll let you guys know. If there is news that comes out, I'll send out the text message. Hopefully I get it to work this week. But if there isn't really any news, we're probably going to skip next week purposefully. And then we'll move over to the following Monday. But guys, don't stop working. There's clients out there, they're still looking to buy. Whatever we can do to help kind of push that, even if it's just to have a candid conversation. You guys know you can always call me. Hey, Mike, I'm in front of somebody. They're kind of unsure. Can you give them your opinion? We'll get on the phone with them right away and we'll talk to them and kind of see. I actually have a consultation with someone today from another realtor. Sorry, that he's not on the call right now, but it's the same thing. She filled out the application. We started running it. She didn't send in any documentation. So when we reached out to her, literally the next day, she's like, "No, I've been talking to some people and they told me to wait and this and that." I told her, "Look, you already filled out the application. Let's sit down. Let's do a consultation." I have a consultation with her at 1 p.m. And we're gonna try to tell her what the pros and what the cons are, and hopefully get her on the road to start looking, because she's looking for an investment property. It's not like how I told you guys, if somebody owns a home and they're looking for a new one, I typically would tell them just wait. But if you're looking for an investment property, you could still look. You can probably get a really good deal. But yeah, we'll talk to you guys next week. Thank you all for coming. Christine, it was nice to see you here. Have a happy holiday. Happy Thanksgiving. Enjoy time with your family. Anything that you need from us, don't hesitate to reach out.